On July 7th, if you own a 401k or an index fund, you bought SpaceX. You didn't click buy. Nobody asked you. Tens of millions of Americans bought it in the very same second, a stock already down about a third from its high, just as the insiders who own almost all of it were about to be allowed to sell. No person decided this. A rule decided it. And a few weeks earlier, the company that writes that rule quietly changed it. This isn't a story about whether SpaceX is a good bet. It's about who actually decides what your savings buy and who gets to rewrite that in the background. Start with the timeline. SpaceX went public on June 12th in the biggest IPO ever, $75 billion. The stock jumped 50%, peaked near 226, then slid to around 150, down roughly a third in 3 weeks. Normally, a brand new stock has to wait. To join the Nasdaq 100, the index behind funds like QQQ, a company used to need at least 3 months on the market and at least 10% of its shares trading freely. Those were safeguards, keep unproven, thinly traded stocks out of the index that sits in millions of retirement accounts. On May 1st, Nasdaq rewrote the rule. Now a top 40 company can join after just 15 trading days, and the 10% float requirement is gone. SpaceX was the first to use it, joining on July 7th, 15 days after its IPO. The effect is mechanical. Around $800 billion tracks the Nasdaq 100, and every one of those funds now had to buy SpaceX, an estimated $4 billion of forced buying, more across other trackers. Only about 4% of SpaceX shares actually trade freely. The rest are locked up with insiders, and those lockups start expiring in mid-July. S&P, meanwhile, refused to change its rules, so SpaceX stays out of the S&P 500 until at least 2027. Now the obvious reaction, so what? My fund buys stocks by a rule instead of me. That's the whole point of index investing. It's cheap, it's diversified, and it beats most people who try to pick. All true. If that were the whole story, there'd be nothing here. So here's the real question. Buying by a rule is normal. Usually a good thing. What happens when the rule stops protecting you and the people who profit from it are the ones who get to change it? 3 things make this different from your fund quietly buying Apple. First, an index fund is a price-agnostic buyer. It never asks whether the price is fair. The index says, hold this much, so it buys at any price. Usually that's harmless because your purchase is a drop in a deep, liquid ocean of shares. Second, the rule you're trusting isn't a law of nature. A private company writes it, and Nasdaq just rewrote it, deleting the one safeguard, the float requirement, that was there to protect passive investors from thinly traded stocks. It did that weeks before the first giant IPO that benefits. Nasdaq makes money attracting big listings. It changed its own rulebook in a direction that helps it, and the people whose money moved never got a vote. Third, and here, the drop in the ocean breaks down. Only about 4% of SpaceX shares trade. Pour billions of forced price-blind buying into that tiny sliver, and you push the price up. So the passive funds, you buy at a price, your own forced buying inflated. And the timing is cruel. The insiders holding the other 96% can start selling the same week. Your retirement money buys the propped up price, they get the exit. That's the flaw. Not that a stock might fall, that's just investing. It's that the one discipline that keeps a price honest, weighing what something costs against what it's worth, is switched off at the moment of the buy, and the trigger was pulled by a rule someone quietly edited for their own benefit. Now be honest about the size. To you, this is tiny. SpaceX is about 1% of the index. Nobody's retirement is wrecked. The problem is the shape of it, a small, one-directional transfer from forced buyers to insiders, repeatable for every future IPO that games the fast track. And it grows with passive money, which in the US is now about half of all the money in funds. The bigger that half gets, the more the price of everything is set by a rule, not a judgment. So what's the fix? 3 approaches, each with a cost. The first is simply what S&P already does. Keep the guardrails, require a waiting period, real profits, and a genuine float before a stock can enter. S&P refused Nasdaq's fast track, which is why SpaceX won't touch the S&P 500 until at least 2027. The upside, passive holders aren't force-fed, unproven, thinly traded, money-losing stocks. The trade-off is real. The index lags the economy. A strict profits rule kept Tesla out of the S&P 500 for years, while it grew into one of the most valuable companies alive. Caution can mean missing the real winners. The second, bring back the float rule on its own. Just require that enough of a company's shares actually trade before the index forces billions into it. That ends the thin float distortion. No more buying a price, your own demand inflated. The trade-off, you'd shut out some founder-controlled giants that genuinely dominate the economy, so the index becomes a slightly less honest picture of where the value really is. The third changes how the buying happens at all. Instead of one price-blind slug of demand on day one, phase a new company in over weeks, or use an equal weight index that doesn't pile into the biggest names, or simply pick a fund that screens. The trade-off, more trading, higher costs, and you're no longer just buying the whole market. And under all three cites a bigger question. Index rules now steer trillions of dollars, more than most laws move, yet they're written by private companies as basically editorial decisions and changed without notice to the people affected. What if a rule that moves that much money carried the duties we put on real market infrastructure? Publish it, justify it, give warning instead of a quiet edit to a rule book. Notice what none of these argues, whether SpaceX is a good company. That's not the question. The question is who decides what your money is made to buy and whether that decision has a guardrail at all. So, you still own SpaceX. You still didn't choose it. Zoom out. Something like half of all the money in American funds now buys on autopilot by rules. And those rules are written by private companies competing to attract the next big listing. The promise of index investing was beautiful and mostly true. You don't have to decide. The fine print is the part nobody reads. Someone else decides for you, and you don't get a say in who or in how they rewrite the rules. So the question this week isn't whether SpaceX goes up or down, it's quieter, and it gets louder every year. More of our savings go on autopilot. When nobody is steering by hand, who is actually flying the plane, and who just rewrote the manual without telling the passengers?